Now, the Fed model is a model that is used by the US Treasury, where they are able to try and predict the valuation or the estimate of the equity market movements. So we are saying the Fed model is given as the following. So we are saying the Fed model ratio is given as the S&P or the Standard & Poor's earnings yield there divided by the 10-year yield, Treasury yield. There. That is how you can be able to get the Fed model ratio, and this Fed model ratio tries to predict the equity market value or the value at any given point in time. Now, moving on, we look at the Yardeni model. Yardeni model. There. Now, Yardeni model incorporates a component of risk in the model, but it's still based on the earnings yield as specified by the Fed ratio there. So we're saying the earnings yield E1 over price naught is given as YB minus D represents a weighting factor, and here you have long-term earnings growth component there, where E1 over P naught is the earnings yield there. Then we have now the YB is the corporate bond or the rating of the corporate bond, or the A-rated corporate bond yield there. D represents a weighting factor, usually around 0.10. You must be given that there, or you need to estimate the weighting factor when trying to estimate the earnings yield. And then we move ahead and look at the L tag. There we are saying is the long-term earnings growth. There, the long-term earnings growth there. Let's look at a model, an example that can be able to try and estimate the earnings yield, or we can be able to also estimate the price component there. Assume the long-term 5-year growth forecast is 9.85% and D is 0.1. If A-rated corporate bond yields 6%, determine the fair earnings yield. Part 2 is asking if the current earnings yield implied by the equity index and projected forward earnings is 5.5, determine whether equities are over or undervalued. Part 3 is asking, using the Yardeni model, calculate the fair value of the market PE ratio. So using the model, the Yardeni model, so we say solution there. Using the Yardeni model, we have it right over here. We have E1 over P naught YB minus D L tag there. So the YB, what is the yield that is yielded, that is being provided by the corporate bond? We're saying is 6%, so it's 0.06 minus the D component, which we're saying the D represents the weighting factor. We've already explained it over here. We've been given 0.10 like that, and the long-term earnings growth rate we have been given as 9.5%, 0.0985. Yes, like that. So how much is the earnings yield? So we're saying is 0.1 multiplied by 0.0985. There is 0.00985. So we get 0.06 minus the answer. We have 0.050, 0.05015, or we are saying it is 5.015%, like that. That is the long-term earnings yield. That is part one. Part two of the question is asking if the current earnings yield implied by the equity index and projected forward earnings is 5.5%. Determine whether the equities are over or under valued. So we are saying that the rule of the thumb in equity investment analysis, if the current market price is greater than the intrinsic value is what you believe the value of the equity index should be, then you are saying it is overvalued there. But if it is the contrary, if the current market price is less than the intrinsic value, undervalued, like that. So in this case, we are comparing the 5.5%, 5.015, which we are saying is 5%, and the 5% or 5.5%, which have actually been given there. So we are comparing this with the 5.5%. So we are saying that the 5.5%, the current market earnings is 5.5%, and this would imply that the Yardney model, based on the Yardney model, it is undervalued. So what happens is that we are saying that the intrinsic value is 5.5% there, and this one, the current market price is 5.015. You can see the current market price is less than the intrinsic value, and hence it is undervalued there. Part 3 was asking, using the Yardney model, calculate the fair value of the market PE ratio. Remember what you're saying, the PE ratio is the market price per share divided by the earnings per share. So what we just need to do is that we just get the inverse of this value. Let me explain it like so. So we're saying here we have part 3. We have E1 over P0. Now the inverse of this, we are saying, will be the P0 over E1. That is the PE ratio. So from your calculator, you can just get the inverse value of 5.015, or we are saying you can get 1 over 0.05015. We'll be able to get the P/E value. In this case, how much is that? So 1 divided by, so we are saying we get 19.94. 19.94 times. That is the PE ratio there. Having looked at the Yardney model, done the Fed model, the Yardney model, and the 10-month moving average, what we just need to understand under the 10-month moving average is that it is not usually used, because the 10-month moving average requires an individual to just get. So we're saying we get the 10-month moving average. What we need to do is that we get the earnings for the 10 months. So January, February, March, April, May, June, July, August, September, and October there. So we're saying this represents 10 months. So we get the earnings yield for this period over here, and we compare them with the previous 10 period moving average there, and with that will be the estimate of the market. Is it going to be a positive increase in the value, or is it going to provide a negative value? Now you're comparing this for the current period versus the previous 10-month period and trying to determine whether it has actually increased or decreased. That is what you're saying is the 10-month moving average in trying to estimate the equity market or determine the equity market valuation for the market there.